You know, when you step into the world of options trading, it's not just one big group of people doing the same thing. It's more like a collection of different tribes, each with its own playbook, its own language. So today, we're going to decode 5 of the most common trader mindsets out there.
So let me ask you this. What kind of options trader are you? And that's not just some idle question. It's actually crucial because the answer really does determine everything. See, there's no one-size-fits-all strategy here. It all comes down to your goals, your appetite for risk, and how you piece together that big market puzzle.
It's just such a diverse world, and honestly, that's what makes it so fascinating. Most traders, you'll find, naturally kind of fall into one of 5 key groups, these archetypes, and they really span the whole spectrum, from super cautious and conservative all the way to the highly speculative.
All right, so let's pull back the curtain and meet these 5 trading personalities, shall we? And as we go through them, try and see if you can spot which one feels most like you.
Okay, first step, we've got the income generator, and I absolutely love this analogy for them. Think of these traders as the landlords of the stock market. Seriously, they treat their options like a rental property, and their whole game is about one thing: generating consistent, reliable cash flow, month after month.
Their entire focus is laser sharp on one thing: selling options to collect that payment. You know, the premium. They're not out there swinging for the fences, trying to hit massive home runs. Nope, they're playing for that steady, predictable income.
And how do they do this? Well, they use some really reliable bread-and-butter tactics. A super common one is selling covered calls against stock they already own. This basically means they agree to sell their stock at a higher price down the road, and for that promise, they get paid cash right now. It's almost like renting out a room in a house you already live in. Or they might sell cash-secured puts, which is kind of like putting in a standing offer to buy a stock you love, but only if it drops to a price you've already decided is a bargain.
All right, now let's do a complete 180 and look at a totally different mindset, the directional speculator. If the income generator is the landlord, these traders, well, they're the fortune tellers of the market.
So unlike our income generator, these traders have a really strong feeling, a conviction that a stock is about to make a big move, either up or down. And they use options as this incredibly powerful tool for leverage. This lets them control a huge position with a relatively small amount of cash, which can amplify their potential gains. But, and this is a big but, it also amplifies the potential losses.
Their toolkit is often pretty straightforward, but man, is it powerful. They might just buy simple calls if they think a stock is going up, or puts if they think it's headed down. Or if they want to get a bit more precise, they might use something called a vertical spread. It's a strategy that still lets them make that directional bet, but it comes with a defined capped risk, which helps them manage costs and the ticking clock of time decay.
Okay, now for a really fascinating type, the volatility trader. These folks are playing a completely different game. They're not the fortune tellers, they're more like meteorologists. They're forecasting the size of the storm, not necessarily where it's going to land.
And look at this. This comparison really just nails the difference, doesn't it? A directional trader is asking, is it going up or down? But the volatility trader, they're asking, is there going to be a big move or no move? They honestly might not even care about the direction, just the size of the price swing when it happens.
What they're really trading is something called implied volatility, or IV. It's basically the market's best guess of how much a stock is expected to move in the future. And their entire goal is to find those situations where they think the market's expectation, that level of fear or excitement, is just plain wrong.
So to do this, they use strategies like straddles and strangles. This is where you buy both a call and a put at the same time, and it's basically a bet on a massive move in either direction. You see this a lot around big news events, like an earnings report. But they can also play the other side of the coin. They can use a strategy like an iron condor to bet that a stock is going to do, well, nothing, that it'll stay quiet and trade within a nice, predictable, tight range.
All right, let's shift gears and talk about the hedger. Now, this group uses options for a reason that's not always about profit, but is arguably just as important: protection.
And this quote just says it all, doesn't it? Hedgers use options as an insurance policy. That is their entire mindset in a nutshell. For them, options are a risk management tool, period. And they are more than willing to pay a premium, just like you pay your car insurance premium, to protect their bigger portfolio from a sudden nasty downturn.
So the key thing to get here is that their main goal isn't to make a bunch of money on the option itself. It's to not lose a bunch of money in their other investments. It's all about managing that downside risk and, preserving the capital they've already built up.
A classic move for a hedger is called the collar. And this breaks it down perfectly. So what they do is, first, they buy a protective put. Think of this like setting a floor for their stock. It guarantees they can't lose more than a certain amount, no matter how far it drops. Then, to help pay for that insurance, they sell a covered call, which, well, it does put a cap on their potential upside, but it makes the protection cheaper, or sometimes even free.
And finally, that brings us to our fifth archetype, the systematic trader. You might also hear them called a quantitative trader, or quant. Basically, these are the scientists of the trading world. Their whole mission is to remove emotion from the equation completely.
Yeah, if these traders aren't listening to the news or operating on gut feelings, no way. Instead, they rely on complex mathematical models to find and then exploit these tiny, repeatable statistical advantages in the market. And they do it over and over and over again.
They use really advanced and often totally automated strategies that are all based on probabilities. We're talking about things like delta-neutral trading, which is a pretty complex strategy that tries to make money from things other than just price moves, or mean reversion, which is basically a bet that sooner or later, prices will snap back to their long-term average.
So let's put it all together. This little chart here is perfect. It lays out all 5 archetypes so clearly. You can really see how the main goal of each trader directly shapes their entire mindset. You've got the landlord collecting rent, the fortune teller predicting the future, the meteorologist watching the storm, the insurer managing risk, and the scientist just running the numbers.
And that brings us right back to where we started. As we wrap this up, the real takeaway for you is to think about which of these roles best fits your own personality when it comes to money. Are you trying to be a landlord, building a steady income stream? Are you a fortune teller, making a bold bet on the future? Or are you an insurer, focused on protecting what you've already built? Figuring out your archetype isn't just a fun little exercise. It's honestly the most critical first step to building a trading strategy that actually works for you. Thanks for tuning in.